Money crosses borders slower than data. You can send a message across the world in milliseconds. You can stream video instantly from another continent. But send money internationally? It might take 2 to 5 days. That delay isn't technological, it's structural. Most banks don't have direct relationships with every other bank in the world. If your bank in the United States needs to send money to a small bank in another country, they likely don't have a direct account with each other. So instead, the payment moves through correspondent banks. Here's how that works. Your bank sends the instruction to a large international bank it trusts. That bank passes the instruction to another bank closer to the recipient. Eventually, the instruction reaches the destination bank. Each bank in the chain holds accounts for the others, often called nostro and vostro accounts. Instead of physically moving money across borders, banks adjust balances they hold with one another. It's a chain of ledger updates. The longer the chain, the slower the process. Each step in that chain introduces processing time, compliance checks, currency conversion, transaction fees. International transfers also involve foreign exchange, or FX. If you send dollars and the recipient receives euros, the system must convert currencies, apply exchange rates, account for market fluctuations, and exchange rates aren't static. Banks often add a spread, a margin, on top of the market rate. This is why international payments often cost more than expected. You're not just paying for movement, you're paying for liquidity, currency, conversion, cross-border compliance, risk management, and every additional hop adds friction. With modern technology, why hasn't this been solved? Because the bottleneck isn't data speed, it's trust and regulation. Every country has different banking laws, different anti-money laundering rules, different reporting standards. Banks must verify the sender, the recipient, the purpose of the transfer, the legality of the transaction, and they must do this while protecting themselves from fraud and sanctions violations. Global trust doesn't scale easily. Instead of one unified system, we have thousands of institutions connected through agreements. International payments are slower because they must pass through layers of institutional trust. The system prioritizes certainty over speed. International payments aren't slow because money moves slowly. They're slow because trust moves slowly. Each transfer crosses institutions, regulations, currencies, and risk thresholds. Once you see international payments as a chain of coordinated ledger updates, not a single direct transfer, the delays make sense. If you want more videos explaining the invisible systems behind everyday life, subscribe to How It Actually Works.